Have you ever wondered why some people stack up wealth with ease, while others grind away for decades and still can't retire? Here's the ugly truth Wall Street prays you never learn. Those safe investments they push are actually retirement wreckers in disguise. Warren Buffett warned us years ago that the financial industry rakes in billions by keeping investors scared and confused, selling them costly products that underperform much simpler options. Today, I'm pulling back the curtain on 7 mainstream holdings that are quietly undermining American retirements. These aren't obscure gimmicks. They're probably sitting in your retirement plan right now, endorsed by your bank and promoted by your broker. And get this, one of these 7 is so toxic it could shave hundreds of thousands of dollars off your nest egg over time. The wealthy steer clear of it, but millions of retirees get trapped. If you're over 40 and have any money in a retirement account, what you're about to hear might be the difference between real freedom and working until you die. Stick with me through the end, and I'll expose the single most dangerous asset on the list. Number 1. Savings accounts, the silent retirement assassin. It drives me crazy seeing smart, hard-working men stash $100,000, $200,000, or more in a standard savings account, thinking they're being cautious. That's not safety, that's financial slow death. While you sleep peacefully, believing your cash is protected, inflation is working non-stop, eroding the buying power of every dollar. The math is merciless. If your savings account pays 0.5% interest and inflation runs at 3%, you lose 2.5% of real value each year. That $100,000 you've saved will only buy what $75,000 buys today after a decade. It's like someone sneaking into your account and stealing $2,500 every single year without you noticing. And who benefits? The banks. They reward you with crumbs. They might tease you with a 2% rate for 6 months, then slash it to 0.3%, while they lend out your money at 6, 8, or even 10%. You're the loser in that setup, and most people don't even realize it. But here's the kicker. True safe alternatives exist that deliver 4%, 5%, or more high-yield online savings accounts, treasury bills backed by the United States government, even I-bonds that adjust automatically for inflation. Keeping $200,000 in one of these instead of a traditional savings account can net you $700,000 more over 20 years. That's the cash you need for a home, the margin between a comfortable retirement and working until you drop. If you think savings accounts are bad news, wait until you hear how long-term bonds can crush your savings when rates rise. Number 2 on our list, long-term bonds, the interest rate booby trap. For decades, advisors have told people nearing retirement, buy bonds, they're safe and steady. In today's market, that advice can be downright toxic. Most investors miss this simple fact. When interest rates climb, bond prices plummet. Picture yourself locking in a 10-year government bond at 2% interest. Then new bonds start yielding 5%. Suddenly, nobody wants your 2% bond, so its market value collapses. 7, though it still pays that original 2%. Interest rate risk can devastate long-duration bonds. Right now, people who snapped up 20-year corporate bonds in the year 2020, when yields were virtually zero, seeing their holdings plunge by 20%, 30%, even 40%. If they cash in to cover medical bills or unexpected costs, they realize huge losses on what they assumed was rock-solid capital. The central bank has been raising interest rates aggressively, and any bond portfolio with extended maturities is getting hammered. Yet financial advisors still pitch these securities to retirees because they earn generous commissions, like selling a car with defective brakes. The smarter approach? Opt for short maturity bond exchange-traded funds that react swiftly to rate changes. Treasury inflation, protected securities for inflation defense, or adjustable rate bond funds, where coupon payments rise alongside rates. Now, Brace yourself for the next retirement. Killer, your retirement account probably holds this right now. Third, most damaging asset, annuities, the retirement snare. If long-term bonds are sneaky, annuities are outright predatory. They're marketed with more emotional hype than a used car lot. Income guaranteed for life. You'll never outlive your funds. Sleep soundly knowing you're safeguarded. The reality. Most annuities are intricate insurance contracts loaded with fees that would make a casino blush. Variable annuities typically impose 3% to 4% in annual charges, plus investment limits and surrender penalties that can stretch 7 to 10 years. The worst part, once you hand over your money, retrieving the principal usually triggers steep penalties. I've seen retirees needing cash in a medical emergency only to discover they'd forfeit 10% or more as surrender fees. That's not insurance, it's extortion. And if you can't decode the fine print in 30 minutes, consider that a massive warning sign. Insurance firms adore these products because they rake in staggering profits while offering a false sense of security. Meanwhile, straightforward alternatives like systematic withdrawal strategies from well-diversified portfolios often deliver better performance with full liquidity and total transparency. But the real sting comes from something even more widespread in your retirement plan. Fourth, most ruinous holding, actively managed mutual funds, the fee vampire. They look well diversified on statements, but under the surface, countless funds are quietly siphoning away your gains through hidden charges, tax inefficiencies, and chronic underperformance. Here's the ugly truth. 80% to 90% of active mutual funds fail to beat the market, yet you pay premium fees for that subpar show. An annual fee of 1.5% might sound trivial, but over 2 decades it can devour more than 25% of your compound growth. Picture this. $500,000 invested in a fund charging 1.5% versus an index fund at 0.1% after 25 years. The disparity in fees alone costs you over $200,000. And that's just the basic expense ratio. Many funds tack on 12B1 fees, upfront sales charges, back-end sales charges, and unleash high portfolio turnover that triggers taxable events. It's like being cut to pieces by 1,000 tiny knives, each one slicing directly into your nest egg. The remedy is almost laughably straightforward. Affordable index funds that simply mirror the market with fees starting at 0.03%. You get the same exposure, often outperform pricier options, and ultimately keep more of your gains. Warren Buffett has championed this approach for decades, yet too many still overpay for underwhelming results. That brings us to another favorite pitch that quietly destroys retirement plans. By now, we've covered several of these traps. You might recognize a few, perhaps the bond fund in your 401k plan or that annuity you bought last year. You are far from alone in falling for these. Fifth most dangerous holding, non-traded real estate investment trusts. On paper, they promise steady income, diversification, and professional oversight. In reality, they become a liquidity black hole. Because they are not listed on any exchange, you cannot sell when you want to. Their valuations are shrouded in secrecy. You see a number on your statement that may bear no resemblance to what you'd actually receive. It is like owning a home but never knowing its true worth until you try to move. Upfront commissions can run 8% to 10%, which means you start in the red. Even worse, many of these REITs suspend redemptions during market slumps, leaving retirees stuck without access to their principal when they need it most. I have seen investors park $100,000 into these vehicles, only to discover years later that their real value had collapsed by 30% below the reported figure. Meanwhile, publicly traded real estate investment trusts offer the same property exposure with full liquidity and transparent pricing. Sixth biggest retirement booby trap, gold and precious metals. Gold feels like a fortress, tangible, historic, and supposedly safe. But for a retiree, it can be an unproductive, wildly volatile asset that bleeds cash rather than generates it. Gold pays no dividends, produces no earnings, and relies solely on someone else paying more later. Its price gyrations are brutal, dropping by 40% over a few years, surging by 60%, then crashing again. That is pure speculation, not a retirement strategy. Owning physical metal adds storage fees, insurance costs, security hassles, and authenticity checks. If you need to liquidate quickly, coin dealers often offer below-market prices. They stoke fear: the dollar is collapsing, stocks are rigged, gold is the only haven. But over the long haul, income-producing assets like stocks and real estate have outpaced precious metals while actually delivering cash flow. Seventh worst asset for your nest egg: cryptocurrency, the ultimate retirement casino. If you are over 40 and channeling real retirement dollars into digital coins, it is time for a serious strategy overhaul. Cryptocurrencies might reshape finance's future, but they are far too unstable to safeguard your retirement savings right now. Their price swings are extreme. Bitcoin, for instance, can plunge by 60% in a matter of weeks, rally, and then crash again. Imagine being 65 and watching half of your lifetime savings disappear because of a single tweet or regulatory shift. That is not smart. Investing is risking your entire future on a high-stakes gamble. Security vulnerabilities only add to the danger. Misplacing your private wallet keys means losing your funds forever. No bank branch to call, no insurance policy to file, no recovery team to turn to. Scammers create worthless coins, hackers breach exchanges, and rug pulls happen every day. Predators dwell in this space, specifically hunting those who don't grasp the technology. Here's a simple rule for crypto in your retirement portfolio: only commit what you could afford to see drop by 80% without losing sleep. If you're truly convinced of its long-term potential, limit your exposure to just 1% or 2% for speculative purposes. The rest of your nest egg should sit in solid, income-generating investments with decades of proven track records. The financial industry will keep marketing confusing products because they profit from your uncertainty and fear. Now that you know the real risks, reinforce your plan with dependable assets and protect the future you've worked so hard to build.